First and foremost, I'm sure you guys have already seen this several times. This is our risk disclaimer. What this will tell you is that, of course, currency trading is a risky endeavor, and it does involve a significant amount of leverage, which can, of course, amplify your losses just as well as your gains. And, of course, you should only trade with capital that is risk capital, so capital that you're prepared to lose. And of course, if you are not sure about anything, and if you're new to this, then certainly evaluate this very closely and seek the advice of a professional if need be. Now, why have a trading strategy? First and foremost, it helps you monitor your trades. Because if you just look at a given chart and say, okay, well, I'm going to trade this, and then you look at another chart and say, okay, well, I'm going to trade that, if there is no system behind it, it becomes that much more difficult to find opportunities. It becomes that much more difficult to actually respond to market conditions once you have the trade on. Whereas if you have a set of rules saying, I get in when this happens, I get out when that happens, responding to how your open trade is behaving becomes that much easier. Because you already know the parameters that you've set out. It obviously will introduce consistency, which makes developing a successful approach that much easier, because you can say, okay, I took steps 1, 2, 3, 4, 5. They didn't work so well. Let me take out step 3, working better. Now let me add a step 6, working better. Okay? That allows you to actually tweak your strategy until you get something that works for you. And if you have that consistency, that is, of course, much easier than if you're doing something completely different every single time. As I alluded to before, it helps you to spot opportunities. Because if you already know systematically what you're looking for, whatever that is, long-term, short-term, technical, not technical, you're able to filter through the markets that much easier. And most importantly, I think, it helps you to know when not to trade. Something I say to people all the time is, it is much better not to make 200 pips than it is to lose 50. A missed opportunity is no money lost, whereas a loss clearly is not. And it's very important to know when not to trade. So if you have a system, if you have a plan, if you have a strategy that tells you trade under these conditions, if those conditions are not met, you don't trade. And you try to minimize that as much as possible. Now, the essentials of a trading strategy are comprised of 4 basic elements. First and foremost, obviously, you have to develop a directional bias. You have to know, or at least decide for yourself, if you think something is going up or if you think something is going down. And obviously, you have to qualify your entry, thereby deciding, do you think something is going down now? So should you get in at this price? Or do you think it's going down next week? So should you wait? Next, determining your stop loss and target, which I really cannot stress enough. Before you ever place a trade, you should know what the target and the stop for that trade is going to be, because that is going to be absolutely critical to establishing whether the trade makes sense or not from a risk-reward perspective, which oftentimes is a lot more important than the actual trade setup itself. There are many, many times, for example, that I get a setup that looks compelling fundamentally, looks compelling technically, but I pass because the risk-reward does not make sense. And we'll get into that in more detail. And finally, of course, since we already touched a bit on risk management, is to define your time frame. Now, if you, for example, used an hourly chart to develop your position and to develop your idea, and you get into the position and we're on day 3 and you're still holding it, chances are, if you got that signal from hourly bars, that signal may no longer be valid. Even more so if it was an even shorter term chart. Let's say you spotted an opportunity on a 15-minute chart, and there you are 3 days later. Chances are the market is in a completely different place then. And so it's very important to define how long you're going to give this trade to work or not. And say to yourself, okay, well, if it's an hourly chart, I'm expecting something to play out over the next maybe day, day and a half. If nothing is happening, maybe I should take that off. Think of it as a stop in terms of time as opposed to in terms of price. Now, in determining your strategy, it is absolutely critical to understand your own personality. And on Daily Effects, actually, we have a great survey that you can take. It's a couple personality questions that will help you to define yours. But your personality is going to be intimately tied to your strategy, because one person is going to be most successful as an active trader. Another person, like myself, is going to be a lot more successful as a long-term trader. And both can be equally successful, and one does not negate the other. For example, I'm probably the longest-term analyst on Daily Effects. My colleague Michael is a scalper. He may think euro-dollar is going up. I may think it's going down. We can both be right, depending on how long of a time frame we're talking about. If he thinks it's going down in the next 10 minutes and I think it's going down in the next 10 months, what he's saying does not necessarily negate what I'm saying whatsoever, and vice versa. And so, knowing what you're comfortable with, knowing what kind of strategy is going to work best with your personality. Are you more of an active trader? Are you more of a swing trader? It's going to be very important. So if you're an active trader, you might look at something like this, where you see a range on a 15-minute chart. You look towards the top of that range and maybe look to either buy or sell at those boundaries, sell at the top, buy at the bottom, or maybe play a breakout. Look for the price to clear that range. If you're a swing trader, so you're a little less active, you might look at a daily chart like this. And you might say, okay, well, sell here, cover there, sell there, and cover there. And that might take you several days, might take you a week or so, and maybe that's what you're comfortable with. Or you might be like me and you trade extremely long term, and you look at something like this, which is a monthly chart, and say, okay, well, that looks like a wedge, looks like the momentum behind the sell-off is starting to narrow. Maybe there is a breakout here. And maybe when I get the confirmation that this breaks out, once it shoots above that wedge, maybe I get in and hold for 6 months, which would only be 6 bars on that chart, which is the way that I do it. But it's going to be very much a function of your own personality. If I attempted, for example, to do what my colleague Mike does, I would probably lose every dime. If he tried to do what I do, I doubt that he would be very successful either. Because it is very much a function of what you can stomach, very much a function of what works with the way your personality works. Now, in terms of qualifying an entry point, obviously there's going to be 2 elements here, a fundamental element and a technical element. In terms of the fundamentals, you begin with the overall picture. Say, you expect U.S. economic growth to be weaker over the next 6 months. Then you hone in on an event trigger. Say, we have an interest rate decision coming up from the Federal Reserve September the 20th through the 21st. So you might say, okay, the overall picture is U.S. economic growth is weakening. Your event trigger would be that rate decision. And if the Federal Reserve comes out and introduces for us another round of quantitative easing, or not. If they do, you sell dollars. If they don't, you don't. Maybe you buy dollars. But essentially what you're doing is you're saying, here is the overall theme, and here is the inflection point in that theme to either go this way or that way. And you use that as a trigger to initiate a trade. Now, as far as technical analysis, very similar approach. You establish your key technical levels overall, and then you look for price to either break them or bounce. And that is going to determine what your trade might be triggered at. Because, to use the same example, if you're looking at buying or selling the US dollar based on what the Fed says on September the 20th through the 21st, you might be looking at a level in euro dollar and say, okay, if it breaks this level and the Fed says this, I'm a buyer. If it breaks this level and the Fed says that, I'm a seller. And what we'll do is we'll actually go through an example of a trade that I am holding currently, which is a short euro-dollar position. And we'll start with qualifying the fundamentals. Those multicolored lines there are leading indicators. The red one is German investor confidence. The blue one is an indication of Eurozone manufacturing and service sector growth. The green one is German business confidence. As you can see, they are both moving lower, or all three of them rather, are moving lower. So that tells us that perhaps the economic outlook for the Eurozone here is starting to deteriorate. Now, why is that? Obviously, we have a severe debt crisis, right? People are very concerned about Greece. They're very concerned about stability in the region. That's clearly not going to do wonders for investor confidence. It's not going to help the individual, which might be thinking, should I buy XYZ thing? Right? Because if you're not confident in the overall stability of the economy, maybe you're not confident about the stability of your job, maybe you're not confident then in your disposable income, and then maybe you're not confident in making whatever major purchase. Same thing would apply to a business thinking if they're going to invest in, let's say, a new factory. And so what that has done, it's really dented confidence, and that has, of course, weighed on growth. Now, that big red line that you see falling off, that's investors. The green one is businesses, but the big black line going in the opposite direction, that is the cost of insuring against a default in any of those high debt countries in Europe. Now, if the cost of insurance is rising, that means the person selling you the insurance thinks that there's a pretty high chance they're going to have to pay out, right? And so they charge you more. So we look at this and say, well, if the markets think that insuring against a default is becoming more expensive, then perhaps a default in one of these countries is becoming more likely. And as you can see, it's starting to hit very high levels compared to where it's been over the past several years. Now, as a way to deal with this stress, Europe has told us that they want to slash deficits to within 3% of GDP, which again, by my sort of very crude estimation, is going to cut their growth rate by about half over the next 2 years or so. And so I look at this entire picture, and the overall landscape makes me think I want to be a euro-dollar seller. Now, qualifying technicals. Since I've decided now that the overall picture doesn't look good and I want to be a euro-dollar seller, now my next question is, well, where do I want to sell it? What specifically is the price? And so I would look at something like this, which is a weekly chart of euro-dollar, and that right triangle you see there, support and resistance, that's a technical pattern that's called a descending triangle. It's a bearish pattern. And as you can see just intuitively, you see price action start to contract, and you see increasingly lower highs, which is telling you the bulls are having increasing trouble holding above that support. The bounces are becoming shallower and shallower and shallower. And so I looked at this setup and I said, okay, so my big picture idea is that euro-dollar is going down. The technicals seem to support that idea. Now, let me zoom in closer to a daily chart and actually pick the point. That line there is that same top of that triangle. I look at that, and then I happen to see a bearish engulfing candlestick pattern, which is a shorter-term sell signal. And that, for me, is my technical trigger to actually get in. Now, before you ever actually place that trade, you've sort of figured out where you want to get in. You've sort of figured out which direction you want to go. But once that trade is on, when do you get out? What happens if your analysis is wrong? How do you minimize losses? Because none of us are perfect, We all make mistakes. So how do you make sure that the times you are wrong are minimal in terms of what they cost you, and the times you are right overwhelm those? How much will it cost you to put this trade on? Not just in terms of what it could make or lose, but in terms of margin, in terms of spread, in terms of positive or negative rollover on holding it. Does it make sense? And so when I look at that same setup, and I look at that bearish engulfing, I think to myself, okay, if I sort of eyeball the next level of support, there is that bottom at 139.68, and that's my big support level, right? You can see it with the naked eye by just drawing a straight line right across that chart. And I see that the top of that bearish engulfing, where it turned, is about 145.36, 145.35, okay? Now, if that signal is correct, price should go down. If price goes up and breaks above that top level and makes a new high, signal is not valid. And if obviously my trigger is that signal, if the signal is not valid, I want to be out. And so what I do is I put my stop loss right there. And say, okay, if price goes up and closes above that level, that bearish engulfing is negated. And so I want to be out. My trading idea was invalidated. Very important here that I'm not looking at a particular pip distance from where I got in. I'm looking at where would price have to go for me to be proven wrong. And then I look at the distance between that and my likely target, which is, since I'm short in this case, a reasonable place where price might find a sticking point on the downside, and I say, well, does this make sense? Does the distance from my place where I'm getting in and the stop, is that too much risk compared to the distance from where I'm getting in and my first target? Is my risk in line with my reward? Is that reward worth risking that much or not? And in situations like this, where I see, okay, well, there might be an intermediate sticking point at about 141.72, and my ultimate target is that bottom. And I count out those risk-reward ratios, and I make a decision. As compelling as the setup is, if that risk-reward ratio doesn't make sense, I pass. As I alluded to earlier, you want to set a realistic time frame. In this case, since I'm trading off a daily chart, I'm perfectly comfortable with this playing out over several weeks or months. In fact, I took that exact position on July the 29th, and I still have it now. Although it surpassed the target at this point, so come the open on Monday, I'll be revising my stop down to lock in some gains. But above all, as I mentioned, one of the greatest advantages of having a systematic approach and a strategy is to know when not to trade, and so to know when you're wrong. The earlier you know you're wrong, the earlier you get out, and the earlier you get out, the smaller your losses. Because at the end of the day, you can always come back and trade another time. There is no need to force it. There's plenty of opportunities. And I have here some quotes that I actually made into a little printout and pasted on my desk to make sure I'm always reminded that if you're right at the wrong time, you're wrong. And if your trade stops out, that may be the greatest thing to happen to that trade. Because if it doesn't stop out, maybe you would have lost a whole lot more. The next one, there of course is a famous one, is that the market can stay irrational longer than you can remain solvent. Just because something should work doesn't mean it's going to. Just because it makes every bit of economic fundamental sense doesn't mean the market thinks so. And at the end of the day, only the market is always right. Only the price is always right. And maybe it's just not time. Now, this brings us directly into money management, which I think is by far the most important aspect of trading successfully. I'll give you an example of money management in action from my own trading. Last year, because I'm a longer-term trader, I placed a grand total of 13 trades. 11 of them were losers. 2 of them were winners. My net gain for the year was around 20%. You might ask how that is possible. And it is entirely a function of money management. Because I stick to very strict money management parameters, and I will not take a trade where the risk is not at least half the reward, or put another way, the reward is not at least twice the risk, or the target is not at least twice the distance from the place I get in than the stop, at least, I'll pass. And so my losers are very small, whereas my winners I let run. And those 2 trades, both of which were, if I recall correctly, something like 2,000 pips plus a piece, easily overwhelmed the losers. And so you always want to think of this not as an ego thing, not as a gamble, but as a business. Are you up for the year? Are you down for the year? Are you making money or are you losing money? At the end of the day, whether you are right or wrong is not important. Whether a given trade stops out or hits its limit is not important. The important thing is, did you make money overall or did you not? Because that's why we're all here, right? We're here to make money. Why else would we trade anything? And so it's very important not to get hung up on this trade stopped out, this trade didn't. That's not the big important thing here. As I said, hitting a stop is one of the best things that can happen to you, oftentimes. Because it is much better to lose a little than a lot. Equally important is position sizing. If you're going to trade like me and be a longer-term trader, you got to have a lot of staying power. And so, in my case, I don't use much leverage at all. Maybe 2 to 1, 3 to 1. A more active trader that's trying to make more off of shorter oscillations may use more, but then tighter stops. And so it's very, very important to look at all of these elements and say, at the end of the day, well, what's my risk? And obviously, position size is going to be a big part of that, because 20 pips with a 10K lot and 20 pips with a 200K lot, in dollar terms, are very different losses. and very different gains. Finally, it is very important to realize that one strategy will not fit in every market condition. When the thing you are looking at is trending, a range-bound strategy is going to be a recipe for disaster, as I found out time and time again as I was learning. The same thing in reverse. If the market is range-bound, attempting to trade it as if it's trending, probably not going to yield very good results. And so, to be a successful trader, because markets will change conditions, is to have a range of strategies. And to be able to say, okay, when it's range-bound, I'm going to do this. When it's trending, I will do that. They are no less systematic. They are no less a set of rules. But just like you might use one approach, say, to driving a car, you may do something different to drive a motorcycle. Still gets you from point A to point B, but differently. Same exact thing. Now, we've sort of sprinkled my strategy throughout here, but if we focus exactly on what it is that I look at, I begin with that big picture. I begin with where I think the overall market, the overall fundamental landscape is going for the next 6 to 12 months or so. And as I showed you guys before, I then use technicals once I've established what I want to buy and what I want to sell to actually figure out at what price, at what time, with what stop, with what target. And because longer-term fundamentals can take months to play out, I'm comfortable holding it. If I was right about nailing a 12-month trend, there is really no reason for me to get out after a week's time. I'll just keep holding. And if it hits my initial objective and keeps moving, I'll move my stop down, lock in some profits, maybe add to the position, and just keep holding it. As long as it works, no reason not to continue doing what works. And I always, as I mentioned earlier, maintain at least a 2-to-1 risk-reward ratio. And the best way, again, to think about this is not in terms of pips, but in terms of dollars. Because depending on what your position size is going to be, that ratio is going to be impacted. And finally, because I am a longer-term trader, I never at any time exceed more than 10-to-1 leverage. Now, that doesn't mean that I raise my margin requirement, right? So my 50-to-1 margin requirement doesn't go anywhere. What I mean here is the total amount of exposure that I have is never more than 10 times the actual dollars I have in my account. So if I'm going to sell a 10K lot of euro dollar, I will always have at least, at the absolute minimum, 1K in the account. Now, as a practical matter, I would never ramp up my leverage to 10-to-1 right away. What I'll usually do is I'll start with something extremely low, 1-to-1, 2-to-1. And as the position begins to develop, ideally, over several months, If I see opportunities to add, I'll add. And of course, that will increase the amount of leverage, and I'll start to scale in. But first, I want to see it work. I want to see the momentum that I was looking for actually develop. And now your questions. Feel free to email me at any time. I can't promise that I'll answer same day, because if there is something like a S&B intervention, I'll be tweeting and trading and writing, but I answer all emails, so certainly feel free. Thank you everybody for coming. Thank you.